We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, October 10th, 2023, and I'm on, as always, with my partner, both of us coming live from Long Island, Dominick. How are you, Dom?
Doing well, Mike. How are you?
I'm all right. I'm in Nassau County. You're in Suffolk County. It seems like it's gloomy in both counties.
The markets had a pretty decent week last week, but the weekend events certainly have put a real damper on the mood of not only what's going on in the Middle East, but here in this country. So we're going to spend a lot of time talking about the markets and such, but in the big scheme of things, it's a sad day, Mike. Sad weekend.
Yeah, we really can't start the show without talking about the events in Israel and the war that has started there. And, number one, it's not a political show, so we're not going to get too deep into, what Israel missed and didn't miss and all that. But just the horrific scenes and the barbaric scenes we all saw on television just makes you stop and really reflect, Dom, on, what could happen in the world. It's horrifying.
Yeah, Mike, we often speak about, whether the economy is and unemployment and all these data points, all these leading economic indicators that we try to follow. And then I call it the meteor effect. Something literally comes out of the sky and you didn't expect it and you didn't see it coming. And in this case, could have tremendous global implications. And we clearly have to keep an eye on it. So we'll continue doing our job every day and we'll monitor the situation. But our hearts clearly break for these poor people who didn't want or call for any of this and certainly didn't deserve it.
Yeah, I'm sure like you, I have clients in Israel, and I spoke to one of my clients' sisters today. She's here in the States, and I reached out to him. I haven't heard back, but she told me that he lives 20 miles outside of Tel Aviv, and he heard the missiles going over his apartment building on Saturday. I mean, it doesn't get any more real than that. So it is horrifying. And as you said, we pray for the people of Israel. We pray for a peaceful resolution. And our job, as you said, is to analyze those ramifications and repercussions and talk to people smarter than us and try to make heads or tails of what happens next and what could possibly happen next.
And from our perspective, Mike, we've had an exposure in oil for a long time now. It's done relatively well. We were able to add to it recently. And that's probably the biggest economic impact is that, of course, Iran sits right there and has the potential to blockade or disrupt shipments of oil through that region. And that could have global implications. So we have to monitor that situation very, very carefully and make some decisions, possibly. But again, doing all that with being sensitive to that these are real human beings that are suffering. And I don't foresee, again, no political call, Mike, but we don't see that scenario resolving itself quickly and in a fashion that unfortunately means greater loss of life. So we'll just keep monitoring, keep doing our job. But there are global implications. We'll see how it all unfolds.
And so far, the market has been calm. It's been orderly. Friday, before we even knew this was going to happen, we had a very good jobs report. You could argue it was too good. The market reacted negatively in the morning. And then go figure, in the afternoon, the market went up on good news. What a concept.
Mike, and you're exactly right. It was a really, really strong jobs number. And normally that's counterintuitive. The strong job number means that there's more pressure on the inflationary economic outcome here. And the Fed would obviously take that into consideration. But I think once real human beings started digging into the report, they realized that there wasn't quite as much wage inflation, and counterintuitive, but good jobs number could be also a negative impact on inflation, because more workers, people can get hired, less pressure on wages, maybe even the ability for employers to bring prices down now. So once they started digging through the actual data, it really wasn't bad at all. I think good news was really good news.
Yeah, and it's okay for good news to be good news, right? And you
We
you
want
raise
people to
interest.
have jobs. We want people to work, make money, pay their bills on time. The good news is good news.
Yes, especially coming into the holiday season. And inflation data is really important because it's one thing, as you pointed out, to create new jobs, but it's another thing for smaller business, especially, and even all businesses, where they're under constant pressure to increase wages, because that has a ripple effect, Dominic. If the car manufacturer has to raise their wages, it just trickles down to everything. And that's where the cycle of inflation continues. So I think that's why, the not as much pressure on wages was perceived to be the good news.
And Mike, to your point, that's exactly what the Fed is focusing on. The other parts of the economy that are contributing to an inflation has started to clean up. It's starting to get better, but wages is a big component. They're really focusing on that. I think the fact that there wasn't quite as much pressure on wages and wage inflation will hopefully give us a better outcome at their next meeting.
And speaking of them, and I have trepidation bringing this up because I'm not trying to be opportunistic or make money or help try to others make money from people's plight. But I think one of the reasons the stock market was also up yesterday and today, fairly healthy gains, is there is little hope if there is increased pressure on oil and oil reserves. Maybe it gives the Fed a reason not to raise interest rates in November and or December. And Dom, that may be another reason why, the market has not fallen out of over a cliff, because there is some hope that maybe the Feds could, take a rest, at least for the next month, with this unrest now geopolitically.
I think that's a really valid point, Mike, and we'll talk to our guest about that particular issue. But I don't think in their normal day-to-day operations, the Fed looks at geopolitical events, but we know historically they have. We know historically they've reacted to geopolitical events by adding liquidity to the economy and emergency reserves to banks. So look, maybe it's off the record, but I think they're going to consider it at least part of the process. And also, interest rates have risen, even though they did not raise interest rates at the last meeting. They talked interest rates into going higher. So whether they actually pull the trigger or not, interest rates are higher today than they were a month ago, than they were 2 months ago. So there's a lot of factors here that would say, hey, maybe they just need to take a pause and get a little bit more information, let the economy settle down a little bit more, and get maybe a clearer picture of what's going on geopolitically before they tighten the screws one more time.
And I agree. And the Feds talk about, rising interest rates. It affects the housing market. That takes a long time, right? Not everyone is buying a home or selling a home, but everyone's buying heat and everyone's buying gas, right? So when fuel costs goes up, that really has an immediate impact on everyone's pocketbook. Everyone.
And
And
psychologically, Mike, we've talked about this one particularly where we have clients that are very well off, yet they feel constrained because they're gassing up their car and it's costing them an extra $10, $20. Don't get me wrong, that's a lot of money, but believe me, when I say, I won't speak for you, that they can afford it, but psychologically, like, no, things have gotten way too expensive and I'm not going to spend the next dollar on something else. So there is a big psychological effect, if not economic effect.
yep, I agree. So look, tonight's guest is Duane Roberts. He's a CFA, Chartered Financial Analyst with Dana Investments, Director of Equities and Portfolio Management. We had Duane on, I can't believe it, November of 2021. The world has changed a little bit since then. But we're anxious to get Duane on and see if he can make some common sense out of the craziness that we've experienced the last 72 hours, among other topics, of course, more mundane like corporate earnings.
Looking forward to it, Mike.
So we'll be right back with Duane Roberts from Dana Investments.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Duane Roberts, CFA at Dana Investments, Director of Equities and Portfolio Management. Good evening, Duane, and welcome back.
Good evening, and thank you. It's a pleasure to be back here.
Welcome back, Duane.
Thank you, Dom.
So, Duane, we have a lot to go over tonight, but I just want to get a little context. You were on the show November 9th, 2021. And the buzzword back then was transitory. Interest rates were transitory and they were temporary. So here we are, 2 years later, the world is upside down. We know now inflation was not transitory, not interest rates. Inflation was extremely sticky. 2022 was a very difficult year for the market. 2023 has been blah. This, I think, is the best way to describe it. So, welcome back. And what you been up to for 2 years?
Trying to stay afloat in this, as you mentioned. I mean, so yeah, I guess you had me on a month before we peaked in this cycle. And obviously 2022 was challenging and difficult. In 2023, we've recovered a lot of that, but it's been recovery in a very narrow part of the market. So, I kind of agree with your description. It's been kind of a blah year. And certainly if you look beyond, the top 10 or so stocks in the market, it really has been a blah year. Yeah, things have changed, but, I agree with you on the circumstances. And I think we probably talked about this a little bit back then. The transitory inflation, I think, was wishful thinking. And it's nice to see the direction of change has moved in the right direction, but we're still not where we should be. It's been interesting to see, for me at least, in the market, how some strategists and other prognosticators have been suggesting, well, the Fed's just going to have to learn to live with higher inflation. I'm just not sure how, given that that's their primary mandate, how do they learn to live with that? Or would the other way to view the circumstances be that the market's going to have to learn to live with higher interest rates? And I think so far it's been more of the latter. And I'm sure the Fed is happy to see inflation coming down, but it's not where they want it to be. And as long as it remains above target, I think that there will be some pressure on interest rates, maybe not to go higher from here, but to remain elevated for longer. And then we also have to pay attention to the fact that inflation is global. This is not just a U.S. phenomenon and not something that the Fed alone or U.S. policy alone can address, because inflation in other parts of the world is as high, actually, in most cases, higher than what we're seeing in the U.S. So it's a global phenomenon. I don't think it'll be corrected in one location. Transitory was wishful thinking, I think, from the very beginning. But I think we're making progress. It's going in the right direction. The jobs number being good news is good news. I mean, I've always preferred environments where good news is good news, but the wage part of that, as you guys were talking about earlier, was fairly muted, and so that's a positive signal. But I don't see, there's no stress, and there's enough inflation still in the system that I don't see the Fed rushing to come to the rescue as they have done so many times in the past, starting in 2008, and really, you could argue going back even a decade before that. So, but certainly since 2008, the markets have adjusted to to zero interest rates and quantitative easing, and now we're getting back to a more normal set of circumstances, a more normal environment, with inflation maybe a little higher than it should be. But in terms of the quantitative easing and the interest rates, I think the exception was what we lived through since 2008, not what we're living through now. But for many people, who haven't been exposed to prior to 2008, or for others who've just forgotten that history, we feel it feels so different today.
Duane, I just want to come back to a point you and Mike brought up. If we look at the S&P, the standard one we look at on TV, it's up, 12, 13% year to date. But the equal weighted S&P, where all 500 stocks are weighted equally, is you basically made zero year to date. And if you take those 7, 10 stocks out of that, the average stock in the S&P is down 10, 15% year to date. Yet there's a lot of really good companies in that group, companies that make real money, have real profits, and earnings have held up pretty respectably year to date. Well, what's going on there, Duane?
Yeah, so Dom, before I get directly to your question, let me just share some stuff, because I'm a data guy, and so the narrowness of the market has just been extreme this year, and for active managers, if you're not a mega cap growth manager, it's been really challenging. So as you mentioned, just some data I have here in front of me that I was looking at over the weekend. The S&P through Friday's close was up 13.7%. The S&P 100, which is just the 100 biggest stocks in that 500 index, up 20.25%. So a huge spread there. And then, as you pointed out, the equal weighted S&P, much closer to zero. But another way of looking at it is just, where is the median stock in the index and in the market? And within the S&P 500, the median stock is up through Friday, was up 13 basis points, not 13.7%. So, huge difference there. And then
basically much less than 1%.
Yeah, much less than 1%. And had we looked at probably Thursday's close, it probably would have been negative, because we had a good day on Friday. If you go to the broader market, the S&P 600, which is the small cap index, the median there was down 3.4%. And even the overall, the kind of the broadest index that I pay attention to is the Russell 3000. It's 3,000 domestic companies. The median there was down 2.1%. So a large majority of stocks in the market are negative on a year-to-date basis, and yet the headline number of the S&P 500 is up 13.7. The Nasdaq, which is another big headline number, but biased toward these mega cap growth stocks, looks very solid as well. But getting now to your question, so that's the environment we're operating in, and it's very unusual. The last time we kind of had a similar market return, just a few years ago, I guess going back to 2014, the S&P 500 was up a very similar level. But if you looked at kind of median stocks, the mid cap and small cap returns, they were all much closer. It was a much broader market. This market has been very narrow, and that started before 2023, but it's become extreme in 2023. But part of what keeps us optimistic about the market, two things. One is that the correction we saw in 2022 really brought the valuations down within the overall market, even within the S&P 500. So you had the price level in the S&P 500 come down, but you had earnings continue to grow through that period. There were a few quarters of negative earnings growth there, but by and large, the earnings trend looked pretty positive. So the combination meant valuations came down a little bit, maybe not as much as one could argue they should, given where interest rates have gone, but the valuations have become more attractive. But again, if you get away from that tech-heavy mega cap part of the market, valuations are much lower than even what the index shows. So the index, I think the S&P 500, the forward PE is between 18 and 19, depending on what day you're looking. The median S&P stock is below 15 times earnings. And if you go to some of the smaller indexes, the mid cap index or the S&P 600 small cap index, in the S&P 600, the median, or not just the median, the overall index PE is 13. And so that's a very attractive level. And we've seen, fundamentally, companies have done very well over the last several years. Earnings have been growing overall. There have been some speed bumps here and there, but earnings have been growing overall. There's been some volatility in certain industries, energy probably top amongst those. But by and large, you've had a lot of companies continue to grow earnings. Revenue has continued to rise. Some of that last year we were questioning how much of it was inflation and how much of it was organic growth. And there was a big part of it that appeared to be inflation. And so the organic weakness was something that was causing us concern. But this year we're seeing the organic numbers looking solid as well. And then margins are under pressure right now, but margins are still at historically high levels. And so from a fundamental perspective, we see lots of opportunities in the market. The market right now, though, is just so focused on kind of the stocks with lots of narrative behind them, or lots of attention in the broader media sphere, that there are a lot of stocks that are being overlooked. And so, the couple of acronyms that people have been bandying about in our business for a long time. The first one was TINA, there is no alternative. Well, that's no longer true, right? When you can go out and invest in treasuries at 5%, or AA corporate fixed income at longer durations at over 6%, you really have to see some optimism within the equity market to justify taking that risk. So at this point, we do have an alternative, but the other part that's still very strong in the market is the FOMO, the fear of missing out, and I see a lot of the narrative-driven stocks. I hesitate to use the word hype because a lot of these stocks are very attractive businesses, but they have strong narratives that maybe are pulling forward a lot of their future returns, and so it makes the investment trickier going forward because the stocks have just been so richly rewarded over the past 5 to 10 years in some cases. I mean, some of these stories have been long-term winners. I take a contrarian point of view on stock prices. I actually like it when stock prices go down because I'm still a net investor, right? I'm still adding money, or most of my clients are still adding money. And so, if you don't have immediate or short-term needs, stock markets going down just mean your future returns get that much better. And so I tend to look at it as opportunity, not as a source of stress. Unfortunately, we've been in the opposite circumstance where stock prices have been really elevated. We've pulled forward a lot of the long-term returns in the equity market up until the last 2 years, and so it's made the forward returns much more challenging. And even I look at some of the things going on, for example, with AI right now. There are a lot of these AI businesses that I really, really like fundamentally. I like the businesses. I think they're going to, I think AI is going to change the world over the next 10 or 20 years in ways that we don't even know yet. But you have to we never got as much into the hype in this cycle or these cycles recently as we did in the late 90s. But the internet was a game changer, and it really has been a game changer. And a lot of the business models that took advantage of the internet, we didn't comprehend until somebody had a brilliant idea 10 years after after the 90s, but yet the infrastructure companies that people were really jumping on. I mean, the classic example to me was Cisco Systems. That's a great business, a great company, but the valuations anticipated so much of that at a price level, I don't think Cisco has even recovered its late 90s price. Now they've paid dividends, there have been other things contributing to the total return. And it's been a great business, but the valuation does eventually matter. And even if you call the fundamentals right, the long-term trends right, if you get the valuation extremely wrong, it can be challenging.
Wayne, let's take a quick break. We're bumping up against the half hour. So let's take a quick break, and we will be right back with Duane Roberts from Dana Investments.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella, and our guest this evening, Duane Roberts, CFA, Chartered Financial Analyst at Dana Investments. Duane, we have to get your input on the war in Israel that started 4 days ago on Saturday, the global impact on the world economy. It may be too soon for Dana to have an opinion or you to have an opinion, but obviously there's always impact in the short term. But do you see any global risks long term if this war drags on?
I do, and the short-term reactions have been were swift on Monday morning, but kind of corrected even within Monday, and certainly reversed a little bit today. But should this be an extended conflict, then it undoubtedly will have impact. So from a macro level, I look at things like the VIX level, which is a measure of uncertainty, and that really hasn't spiked. I look at what some people consider the safety trades, and while they maybe spiked a little bit, the dollar got stronger yesterday. Interest rates went higher, certainly in the Treasury complex. Yesterday, that all reversed today. So I do think that there are potential long-term impacts that could be subtle, but the most obvious one will be in the commodities realm. Oil being first and foremost, the spillover effects in the region. If there are further issues with Iran, and that potentially could shut down 3 million barrels a day. If there are other issues in terms of transportation in the Gulf region that affects the transportation of oil, that could have an impact. There are other commodities that come out of the Middle East. I read today that 3% of all potash in the world transits through an Israeli port. So to the extent that folks are dependent on potash, that could be a commodity impact in effect. And economies have been, 3% doesn't sound like a lot, but at the margin it can make a big swing. And so we'll see that. There are a lot of tech businesses in Israel that potentially could be shut down for a variety of reasons, at least in the short term, and so that could have an impact. So we'll just have to see. I mean, you saw in transportation. I mean, the airlines were all down pretty big yesterday, and you've probably heard. I've heard, nobody I know personally, but friends of friends who were in Israel who. Fortunately, we're all able, the ones, at least the friends of my friends, have all been able to get out, but they were all scrambling to figure out, how to get to a country where they could get on an airplane that would actually let them fly back to the U.S. So it's a challenging time, and I think it will be a challenge to the world economy if this stretches out, depending on how long it stretches out. And that I'm not going to even try to predict. I mean, think about when Ukraine and Russia started. Many people were projecting that to be short, and here we are 18 months later. And so, hopefully it's a short conflict for a lot of reasons. I hope it's a short conflict, least among them economic. But we just don't know. And I'm wise enough not to try to venture that guess because I have no knowledge there.
Duane, me and Mike alluded to it, but is this something that the Fed would take into consideration in their liquidity interest rate policy? Is that something that maybe behind the scenes does get discussed?
I think it does, but it's again a question of how much does it have an effect on the world economy and the U.S. economy, and to the extent that those impacts are limited, there are other effects that the ongoing interest rate issue, or excuse me, inflation issues in the U.S. Labor being still the demand being fairly strong, which so far has not been detrimental. But I think there are other macro factors that are probably bigger issues, but the spillover could be significant. And if it does become a wider conflict, a longer conflict that does create economic dynamics, then you could see the Fed the Fed reacting to that. But I don't see the Fed reacting specifically to this event yet, but it would be a second order effect. They would see economic consequences of what's going on, and if necessary, respond to those. In the short term, I don't see any changes to their policy. At least my view of their policy right now is they're not moving in either direction, in my view, anytime soon. And I don't see that this has changed that yet, given the strength of everything else we're seeing. So hopefully, earnings continue to come in on the plus side. The inflation numbers continue to move down, not where they need to be, but continue to move down. Labor still looks strong, and yet not excessively inflationary at the moment. I just don't see that there's a compelling reason for the Fed to start working rates down until inflation is much closer to their targets,
which is 2%, correct?
Yeah, depending on the measure you're using. 2% is their stated target. There are some numbers that at least some folks I read argue that their real number is 2.5% based on the gauge that they use. But 2% at the CPI number would be, that's always been the stated target. And I'm not sure there's anything magical about that number. It's just what most central banks seem to focus on.
Yeah. Dom and I have been very consistent all year, where we felt it would be unlikely and probably counterproductive for the Feds to lower interest rates in 2023. We felt it would take some global or domestic shock to the economy, or just the economy falling off a cliff. And it appears at the moment we're probably going to be correct. They're not going to lower interest rates this year. But we can't let you go without talking about the R word. Do you forecast, or does Dana forecast, a recession for some time in 2024, or do we get to avoid that?
So a lot of it is, the soft landing or recession. Some of it depends on definitions. I'd say the house view at Dana is pretty optimistic, in that we think we're going to be able to, most of the domestic stocks that we're looking at, the companies that those stocks represent, we think are going to be able to power through this. Not that, a recession, should it happen, will affect everybody, but some more than others. My personal view is fairly in line with that, which is, I guess, the soft landing view. I've had the soft landing view for some time. And with soft landing, my definition of soft landing, certainly a year ago or at the beginning of this year, wasn't that we would necessarily avoid a recession, but that any recession would be short and shallow. But I think the resiliency of the U.S. economy has been remarkable. And even for an optimistic group like us, I think we've been very pleased with how well the economy has held up. And I think that's part of what's supporting the higher for longer interest rate narrative. So I think the economy has shown that, some optimism was justified. We've agreed with your point on interest rates. We didn't think interest rates would be cut anytime soon. we're still debating whether the market's anticipation of first quarter is maybe too soon. So so I think we're going to, again, it depends on definitions. I think the soft landing, that's the description I'm comfortable with, because it avoids the hard definition. If we do have a recession, I think it'll be short and shallow. So we remain optimistic. There are some challenges. Obviously, the lag, to interest rates will be an ongoing challenge, because higher interest rates are just resetting and coming into play for a lot of businesses. The weakening of the consumer particularly at the lower end, with higher credit card debt that's been growing for a couple of years, with the lack of government programs that were part of the COVID responses, including the end of the moratorium on student debt repayments. There are going to be some challenges in the market, but by and large, we're still optimistic. We see a lot of resilience, more so than, frankly, we even expected in the U.S. economy this year. And consequently, we remain fairly optimistic. Again, in the middle of the market, we're not expecting the leadership to remain in the higher priced, higher valuation level mega cap stocks that have been driving the market thus far. But we see a lot of stocks below those mega cap names that have performed quite well over the last 5 years or so, and their stocks may be up, but their earnings are up even more.
Wayne, so if I can just focus on that for a minute, we speak to a lot of people like yourself and listen and have them on this very show, and some are incredibly optimistic and some are not. They can be downright pessimistic, but it all ties back down to earnings. And the argument here is earnings are just not going to hold up through the fourth quarter, and certainly not hold up or be quite as optimistic for 2024. Companies' earnings have held up pretty good so far, but what do you guys think going forward?
Yeah, I mean, well, certainly my personal view, and I think this is shared within the team, is that earnings are going to be okay. So I mean, we've been facing the challenge of earnings coming down for a year, really, right? So we actually did have a couple of quarters where earnings growth was negative, and where earnings revisions prior to the beginning of an earnings season were pretty significantly negative, which is the typical pattern. I mean, people come in, analysts and company management start the year optimistic, and then as reality sets in, they adjust the numbers, and typically the adjustments are down. But we've seen recently in the earnings adjustments over the last couple of months, going into the beginning of this earnings season, that those adjustments have been fairly slight, and so that's a positive signal. The earnings reports last quarter were by and large better than certainly better than expectations, but even better than average. I mean, the average earnings season sees earnings beating expectations. I mean, it's just the game that Wall Street plays, and setting expectations at a level that most companies are going to beat. But the overall beat ratio, the overall percentage of the companies in the S&P 500 that beat was 80%, and that's a very high number. Typically, it's mid 60s, and so I think the earnings story has been, again, the word I keep using is resilient. The earnings story has been resilient because the economy has been resilient, the consumer has been resilient. There have been lots of headwinds, and yet we've been able to navigate those. And this was part of my view for a long time, is that I don't think zero interest rates were actually necessary, and I think created some issues by being extended too long. And I think the economy has shown, and part of it is there was some fiscal policy that supported things, but we've shown over the last year, 15 months, 18 months, that higher interest rates are not the only thing that was supporting the economy. We have a strong economy. We have a resilient economy. We have businesses that are structurally very strong, and we're seeing that those companies are delivering. Even, interest rates were not the only thing supporting this economy, and they weren't necessary. And so I think we're demonstrating that now. My view on earnings is that I think expectations will be met, because I do think that there are enough positive sources of revenue growth, and that even with margins being squeezed, they're still going to be higher than the historical averages for most businesses. So even though the interest expense may go up, I think there are enough countervailing forces that I remain fairly bullish on the earnings season and what we'll see there. So again, that's part of why I think the soft landing is becoming more and more a possibility. Again, how you define soft landing is the key phrase there, or the key concept. But at this point, I'm not worried, and certainly for the companies we're invested in, there are very few of those where we see kind of earnings risk that makes us uncomfortable. Most of these companies, because they've been fairly steady, even through 2022 when the markets were coming down, the earnings story was fairly strong. Again, that middle of the market, we just think there's lots of opportunity there, and some very solid economic performers. The fundamental performance of these companies, these businesses, look strong, and so I'm not pessimistic on earnings at all. We're not wildly bullish on earnings because we do see some headwinds, but I would say I'm probably currently at or where the consensus is, and the consensus is fairly strong. Whereas if you'd gone back to me 2 years ago, I was probably well below consensus, because I just think expectations were getting too far out front. And maybe what's happened is with interest rates so high, that just creates some nervousness for a lot of people, and they expect the economy to respond to high rates with a recession, and so consequently they expect earnings to come down.
So speaking of nervousness, you teed up my next question perfectly.
Yeah.
You sit with clients all day long like we do. We heard everything you said. Clients go home at night, they turn on the TV. The video in Israel is horrifying. The global headlines are horrifying. The media compounds everything. So how do you answer the
Mike,
question,
we won't even
Duane?
talk about the political situation in this country.
Right.
Yeah, I didn't even mention that. So how do you answer the question, Duane, that Dominick and I get every day? Why don't we just sit this out for 6 months? I'll make my 5% on a 6-month treasury or a money market. And can we pick this up again in March or April? How do you, and I know you get the same question. You have to.
We do.
How do you answer that question?
So I'd say among Dana's client base, we are seeing a rising allocation to fixed income. I think that's perfectly reasonable in this context. I mean, like you said, when you can get treasuries at over 5% yield, and some very high quality corporates at over 6%, why not take down the risk a little bit? I mean, we're still bullish on equities, but we're less bullish maybe on the S&P 500, just because this idea of kind of pulling forward returns. I mean, the S&P 500 has a very expensive forward multiple, particularly in light of a 5% interest rate environment, where you have that alternative. But that forward multiple is very much skewed by the largest stocks, and if you take those out, the multiple of the S&P 500 looks reasonably attractive. And as I said before, if you go to the S&P 400, the S&P 600 mid cap and small cap indexes, it's very attractive, and these businesses look solid. So if we avoid the major recession, which I believe we will, then I think equities look very promising, but I think we've pulled forward a lot of the returns in the S&P 500 because of its cap-weighted nature, and the better opportunities are going to be in the bottom 450 stocks by market cap of the S&P 500 and the mid cap and small cap markets. So we are seeing, to get back to your question, we are seeing more people elevating their fixed income allocation, which we think is certainly appropriate. But we remain optimistic enough on equities that we we don't suggest certainly getting out of the market. We just think you need to maybe look more broadly at the market, at mid cap, small cap parts of the market where the opportunities are pretty strong, and the performance over the last 5 years from a fundamental perspective of many of these businesses really hasn't been fully rewarded.
Duane, we're getting close to the end. I can't believe it, but if I could throw one softball at you, active management versus passive, an estimate, you brought up the Russell 3000, estimated 1/3 to 1/2 of the Russell 3000, those companies don't make enough money to even pay interest on their debt. Right. How important is it to be really, really selective in this kind of environment?
So, you do and I remember this happened, I don't know, probably 6 years ago now. I do a lot of statistical work looking at characteristics of the market, and one of the things I do is I often look at valuation metrics based on medians within within a sector. And I think it was in 2017, looking at the broad market index in healthcare. So I tend to do this sector by sector. In healthcare, I was getting really bizarre results. And it was because the median income for a stock in the healthcare sector was negative. There were more companies losing money in healthcare at that point in time than made money. Now, the overall sector probably was making money, but the median stock was not. So, so that does create, some challenges. There are a lot of stocks in the market that do look weak. There are some stocks that are probably going to be hit harder by the ongoing, higher for longer interest rates. So active management will become more important to navigate those waters. I mean, passive has been the way to go, because passive rewards size and momentum, and the biggest stocks have had the most momentum, and so concentrating in those stocks has been very rewarding, and it's made it very challenging for active managers to keep up with the benchmarks, which are cap weighted. But going forward, one of the reasons I pay attention to the S&P indexes over the Russell indexes, particularly the small cap, even though the Russell 2000 seems to be the dominant small cap index in the marketplace, is that there is a quality screening that goes into that as well. And so you take away a lot of those negative income companies. But so, I think you have to be careful. There is a lot of fluff in the market through negative income. We've seen that the private markets have changed. The SPAC rush and other things brought a lot of companies public, perhaps earlier than they deserve to go public, before they were really profitable. We've always had some negative income companies, but the proportion of new offerings through SPAC or IPO in the last couple of years that have had negative income is significantly elevated versus what it was 10, 15, 20 years ago. So, that's a concern I have of the broader market. But as I said, there are plenty of things in the middle. So not the negative income companies, not the small number of growth stocks that have been highly rewarded over the last 10 years. But in that middle, there are a lot of very attractive businesses. And as long-term investors, as active managers, we're looking at those businesses, and we're still finding lots of healthy opportunities that we think are attractively priced. So I think, we've been saying this for a long time, and it hasn't come true yet. has not come to fruition. We believe that active management will get its day in the sun, just because so much of those returns, again, in the indexes, the cap weighted indexes have been pulled forward with the average PE of the Magnificent Seven, I think is 35 times earnings. They have growth that maybe justifies a premium, but at almost twice what the rest of the S&P 500 looks like. Is that justified? When you're already in the case of Apple, a $3 trillion market cap company, how much do you grow that will allow you to sustain those types of forward returns? Magnificent Seven on a year-to-date basis through Friday was up 91% on average. That's extreme concentration in returns. And that's where the opportunity of active versus passive, you're not going to see that kind of passive return generated from 7 companies just going up, over 90% on average.
I wish we had another half an hour, but we are out of time, and I apologize for cutting you off. It was a compelling point. And congratulations on being named the CNBC Top 100. You're in the top 5. So you've been a great partner, and thank you for your time tonight, and thank you for your partnership.
Thank you. We always enjoy these conversations, enjoy working with you guys. So take care. Have a great evening.
We're going to have to get you back a lot sooner than the last time. So I appreciate you spending the time with us tonight.
Sure.
And we'll be back next week with a new episode of the Lebenthal Report. Have a good night, everybody.